Hi everyone, today we will explore the world of mergers and acquisitions or M&A using the Pecha Kucha presentation template. Let's understand how companies combine strengths and assets to drive growth, gain competitive advantages, and reshape industries. Mergers and acquisitions involve the consolidation of companies or assets, aiming to stimulate growth, expand market share, or influence supply chains. These transactions can be transformative, reshaping the business landscape and creating new market leaders. There are several types of M&A transactions, including mergers, acquisitions, consolidations, public offerings, asset acquisitions, and management buyouts. Each type serves different strategic objectives and brings its own set of challenges and opportunities. Let's delve into mergers and acquisitions. Mergers occur when two entities unite to form a new organization, combining their assets, resources, and operations into a new legal entity. Acquisitions involve one company taking over another, resulting in the acquiring company absorbing the target, either maintaining it as a subsidiary or fully integrating. The main difference is in the way the deal is communicated to the target company's stakeholders. While friendly takeover may be termed mergers, where both CEOs agree to join forces, hostile bid or hostile takeovers, where the target company opposes the purchase, are typically classified as takeovers. Mergers were based on company relationships. Horizontal mergers involve direct competitors. Vertical mergers occur between a company and its supplier or customer. Generic mergers serve the same consumers differently. Market extension mergers sell the same product in different markets, and conglomerations involve companies from different businesses are merging. Why do M&A? Companies pursue mergers and acquisitions for a variety of reasons, including growth, competitive advantages, synergies, increased market share, and tax benefits. These transactions offer strategic opportunities to increase shareholder value and drive long-term success. When talking about how these transactions can occur, acquisitions can be financed through cash, equity, debt, or a combination. Investment banks may offer financing to attract bids, known as levered buyouts (LBOs), using borrowed capital with the target company's assets as collateral. Reverse mergers allow private companies to go public quickly by acquiring a shell company. Value an M&A deal involves different seller and buyer perspectives. Key metrics include the price-to-earnings ratio, compare the offer to industry peers, enterprise value to sales ratio, using revenue multiples, and discounted cash flows analysis, estimating present value based on future cash flows through the weighted average cost of capital. Is there any way to say no? To guard against hostile takeovers, companies use defense strategies like poison pills. These provisions make acquisitions less attractive by diluting share value or raising costs, protecting shareholders' interests and giving the target company more negotiation leverage. M&A transactions can significantly impact companies. Successful ones can drive growth and innovation, but they can also lead to workforce reductions, culture shock, and create a negative image of the company. For example, redundant positions such as having to manage overseeing similar functions can be eliminated to further minimize costs. Let's examine a successful M&A case, the acquisition of Netshoes by Magazine Luiza. This strategic move enabled Magazine Luiza to expand its online retail presence, increase its market share, and enhance its product offerings. From 2010 to now, Netshoes made a lot of brand awareness and grew revenue, but saw its logistics costs, inventories, and squeezed margins increase. A business model that didn't make a profit, not even going public in New York in 2017 to finance expenses, seemed to work. After a failed IPO, Netshoes shares plummeted from $24 to $1.29. This led to M&A talks with SBF Group and Magazine Luiza. Despite a higher offer from SBF, Netshoes accepted Magazine Luiza's lower bid of $3.70 per share due to urgent cash needs, resulting in a $150 million deal. Magazine Luiza acquired Netshoes to boost its market share, adding 250,000 products and over 7 million consumers, using 1,100 stores reduces logistical costs. In Q1 2020, e-commerce grew by 72.6%, and digital sales rose 203% in May. Now let's explore a failure case, the acquisition of Skype by eBay. Despite high expectations, the integration of Skype into eBay's platform failed to deliver the anticipated synergies, highlighting the importance of strategic alignment and due diligence in M&A transactions. eBay's acquisition of Skype, valued at over $2 billion, aimed to enhance communication but failed to add significant value. Despite Skype's profitability, eBay users showed little interest in using it to resolve product issues. The acquisition fell as eBay misjudged its customers' needs. They invested heavily in Skype without understanding their own customers' experience. eBay's strengths lay in resolving issues through comments and emails, not direct interaction. Later, Skype was sold to private investors, with eBay retaining 30% control. eBay's experience with Skype highlights the challenge of integration, spirit business and cultures in M&A transactions. Despite initial optimism, the deal failed to generate the expected synergies, leading to finance losses and strategic setbacks for eBay. In conclusion, mergers and acquisitions offer strategic opportunities for companies to drive growth, expand market share, and create value. However, successful M&A requires careful planning, execution, and integration to realize synergies and deliver long-term success.